Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to Ind AS 20, which deals with accounting for government grant and disclosure of government assistance. What does government grant mean? What are its recognition principles and accounting treatment? What are its objectives? What are the scope of government grant? What are the non-monetary grant? Presentation, how we will present in the financial statement. What are the repayment criteria if the condition is not fulfilled? What is government assistance? Difference between Ind AS 20 and AS 12 and the disclosure requirements. These are the contents which are going to discuss step by step. Let's start. Firstly is the government grant. What are the objectives of this Ind AS? This Ind AS talks about or deals with government grant and government assistance. Generally, government grant, we do the accounting treatment recognition criteria and the disclosure requirement is there in this Ind AS, and related to government assistance, only disclosure part is there in this Ind AS. The guidance related to the disclosures of government assistance, because why the disclosure is there in related to government assistance, which because it's a non-monetary grant which are given by the government to the company, kind of support given by the government to the company. So only disclosure part is there. There is no monetary terms, exchange of monetary terms between the company and the government. So only disclosure requirement is there related to government assistance. But in government grant, there is a monetary exchange between the government and the company. Government give the monetary support to the company in order to develop the company in the remote area, so they will get the employment, the people over there get the employment, the livelihood. Grant given by the government to the guidance related to accounting treatment and disclosure part related to government grant is given in this index. So we will discuss about the government grant, its accounting treatment, its disclosure requirements, and related to government assistance, only disclosure requirement is there. So let's start. Government, what are the scope? Government grant includes what? And what are what the government grant does not include? Generally, government grant is applicable to all type of grant which is given by the government to the company, both in terms of monetary and non-monetary aspect, and other forms of government assistance. Government grant is what? Any kind of help given by the government to the company. That company will develop anything new, like any vaccine, formula of vaccine, or any business in a remote area. The government give that kind of monetary help to the company to develop that. That grant is to be given and treated as a government grant. Like for example, government has given a land to a company that in a remote area, that I am giving a 50 lakh rupees land free of cost. You will fulfill the condition, then I will give you the land free of cost. During a period of 3 years or 4 years, you will fulfill the condition and take that land free of cost. But you have to fulfill that condition. If the company fulfill that condition, they will recognize that as a government grant. And if the company unable to fulfill that condition, the company has to repay that grant to the government. So it's all about the fulfillment of the condition, then only they will recognize. If there is a probable, reasonable assurance that the company will assure that they will fulfill the condition, and the two criteria is there. If the company will fulfill, reasonably assure that they will fulfill the condition, they will treat that grant as a government grant in its financial statement. And government assistance is what? It's a kind of support which the government is giving to the company in other than monetary support. Any kind of support which the government is giving to the company to develop that company. So that kind of assistance is the government assistance. Government assistance includes government grant also. So government assistance is a wider term, but it does not include. This standard does not applies to government participant. Who are the government participant? Suppose the government is having a share. Government is a holding company of any company and giving any kind of support, monetary, non-monetary support to that company. So it's not a government grant. It's a government participant. They are the participant of that company. If the government hold any 10% share of that company or 20% or 40%, any part of the equity the government is holding and providing any kind of assistance, that is not an assistance. It's a kind of government is giving not an any kind of assistance because government itself is a participant in that company. So it's not a grant or any kind of assistance. Any kind of biological asset, if the government is giving asset, if any, it does, this standard does not deals with biological asset. The biological assets standard is related to Ind AS 41, which deals with the biological asset. If the government give any biological asset to any company, that is not a government assistance or that is not a government grant. Income tax related assistance, for example, there is a 80IA, 80IB, all these are income tax holidays are there, which the government is providing as per Income Tax Act, but which does not include in the books of accounts. So that kind of assistance is not included in the Ind AS in this standard, because it's an income tax assistance. It is related to the holidays tax benefit which the company is getting as per Income Tax Act, not as per accounting aspects. So this standard does not deal with income tax related assistance like any kind of benefit as per income tax. Then accounting of government grants reflecting the effect for change in prices, means any kind of grant which reflects the effect for changing price, that does not include in this standard. So this standard is applicable to every type of government grants and other form of assistance except government participants, biological assets, income tax related tax holidays, and accounting for government grant reflecting the effect for change prices. So these are the scope, these are the negative list which does not include in these standards. Then comes the definition of government. Who is government? Government, who is the government? Government means central government, state government, like central government, state government means government of Maharashtra, government of Rajasthan, government of West Bengal, government agencies, similar bodies, whether local, national, international. Local means municipal bodies, municipal corporations, national bodies, international means UNICEF, UNESCO, WHO, all these are the international bodies. Government agencies are what? Who are the government agencies? That is NCAs, NMDCs, RBI, IRDA. These are the government agencies. So state government, central government, government agencies, similar bodies, whether local, national, international, and examples are MCA, NMDC, RBI, IRDA, WHO are the international, World Health Organization, Municipal Corporation of Kolkata, West Bengal, Municipal Corporation of Delhi, anywhere the municipal corporation that includes the government, and UNESCO is the international bodies, American embassies, all these are the agencies. So These includes government, government means central government, state government, government agencies, similar bodies, whether local, national or international. The examples which I given mentioned here. And but if the government is holding company or joint venture or investor and providing some benefit to the company, it holds equity. Does not cover in this standard. As I mentioned, the government participants, those who are the holding company, joint venture investor, and any they are providing any benefit to that company to whom they are holding joint venture investor and holds any equity and give any kind of assistance, any kind of benefit to the company does not cover under this standard. Definition of government grant. What is government grant? Government grant are assistance. It's a kind of assistance given by the government in the form of transfer of resources to a entity in return for the past or future compliances with certain conditions relating to the operating activity of the entity. It means government grant are the assistance given by the government in transfer of resources to an entity in return for the past or future compliances, whether the company has complied the condition in past, so the government is reimbursing that grant to the company, or the company will comply that condition in future, so the government is giving the support to the company to develop in advance. So any kind of support is given by the government to the company for the condition fulfillment, for the condition which the company has already fulfilled in the past, the reimbursement of that expenses, or the company will do in the future. The condition is to required to be fulfilled. The company is giving the grant today for the compliances which the company will fulfill in the future. So that kind of grant with the companies, the government is giving is the government grant. Any kind of subsidy given by the government for procurement of material, free allotment of land by the government. If the government is giving any for procurement of material, you procure that material, I will giving you subsidy, or any kind of land given by the government for development of any business or any factory in the remote area. Interest free loan, if the government is giving interest free loan or at a concessional rate, even the government is giving at interest free loan or at a concessional rate like 10% market rate is there, the government is giving at 4%. So at a concessional rate the government is giving the loan, forgivable loan, like if you will fulfill the condition, I will forgive your loan. I will not demand any loan from you. You will take the loan. Now you will fulfill the condition and your loan is to be waived off. I will not ask for you for the repayment of the loan. But if you will not fulfill, then you have to repay. Forgivable loan is the government grant where entity meets the terms of forgiveness of the loan. So these are the examples, and the government grant received from the government against reimbursement of expenses. Whether the company has fulfilled the condition, they had expense all they cost, the government is giving the reimbursement of the expenses, or against expenses or fulfillment of the condition in future, the government will say you will fulfill the condition in future, I will pay you today. The government grant exclude those government assistance which cannot have a value and cannot distinguish from normal trading transactions. Means government grant does not exclude government assistance which do not have a monetary value, which cannot have a value and cannot distinguish from normal trading transactions. Comes, what are the conditions which if the company recognize the government in its book, they have to fulfill the condition. What are the conditions? When an entity should recognize government grant in its financial statement, only when the company will fulfill these two conditions. Subject to the fulfillment of these two conditions, what are the conditions? when there is a reasonable assurance that the company will assure that they will comply with the condition, they will fulfill the condition, then only they will recognize or the grant will be received. Any of the criteria, if the company is not going to fulfill, then if the company will not receive the grant, it will not treat it as a government grant. If the company is not reasonably assured that they will fulfill the condition, it will be not treated as a government grant. If both the condition is to be fulfilled, that there is a reasonable assurance that the entity will comply with the condition and the grant will be received, then only the company will treat that as a government grant. Now, what are the accounting treatment of the government grant? How the treatment is to be done in the books by the company? Firstly, make sure that it's a government grant. Firstly, the company will sure that it's a government grant having a monetary value. Then only it will be recognized in the books as a government grant. In order to make surety that it's a government grant, firstly, the grant is to be received from the government only. If any private public company is giving grant, any kind of benefit to the company, private company, it's not a government grant. The grant is to be received from the government only, and that have a monetary value, and there is a reasonable assurity that the company will fulfill the condition and the grant is to be received, then only they will treat that kind of benefit as a government grant in its financial statement. Recognized in the profit and loss for the period in which the expense. There are two type of grants are there. One, there a capital expenditure kind of grant and a revenue expenditure kind of grant. Capital expenditure, like government is giving any kind of asset, or revenue kind of grant is kind of expense which you had already company has already incurred and get the reimbursement from the government. So recognize in the profit and loss for the period in which expense for the which grant has been received on a systematic manner. Means if the grant is received by the company in year 1 and it is to be amortized over a period of 5 years, so that the condition is to be fulfilled for within a 5 years, the government has given a grant of 10 lakh rupees and it is to be, and the condition is to be fulfilled within the period of 5 years, so it is to be amortized over a period of 5 years. So suppose it will be explained by example. Suppose a company has purchased a tower. A tower company has purchased a tower of costing rupees 80 lakhs. And for that tower, government has ठीक है आप tower बना रहे हो, I will give you a grant of 40 lakhs for that tower. So the company's cost is 40 lakhs and government has given that subsidy of 40 lakhs. So in total there is 80 lakhs cost and government has given a grant of 40 lakhs. The actual cost of company is 40 lakhs only, because 40 lakhs is to be received from the government. So, but that grant is subject to the fulfillment of a condition over a period of 20 years. If the company will fulfill that condition, then only the company will receive the grant. Otherwise, if the company will not fulfill the condition, it has to be repaid by the company to the government. So how the company will treat in its books, there is a two approach. That is, first approach is the gross approach and second approach is the net approach. In gross approach, the cost and the grant is to be shown separately, but in net approach is to be from cost, the grant is to be reduced. Example, first approach, we will discuss about the net approach. In net approach, we will deduct the cost of tower, from the cost of tower the grant, and the remaining we will from the remaining we will do the depreciation over there, and the expense, the depreciation is to be expensed off in the PL account. So this is the net approach which I am going to discuss right now. like the cost of tower is 80 lakhs, from that we will reduce the grant which is given by the government to the company, that is 40 lakhs, and the net cost is 40 lakhs, and from that we will do the depreciation over a period of 20 years. We will depreciate the asset over a period of 20 years. So this is the net approach, in which we will show the cost of tower as a PPE in the asset side of the balance sheet, and we will reduce the government grant from that, and we will reduce the depreciation, and depreciation is to be charged to the PL as an expense. And second approach in this example is the gross approach. In this we will show the cost of tower and government grants separately. Cost of tower is 80 lakhs, which is shown under balance sheet as an asset, as a PPE, and a government grant will be recognized as a deferred liability in the liability side, amounting to rupees 40 lakhs. And in this example we will depreciate the asset, that is 80 divided by 20 years, that is 4 lakh is the depreciation. We will expense of in the P&L as a depreciation, and government grant is to be amortized over a period of 20 years, which is an income which we will treat as an income over a period of 20 years, that is 40 divided 20 years, 40 lakh divided by 20 years. We will amortize that in liability as an income. We will show 2 lakhs as an income over a period of 20 years. In net, we will see that 4 lakhs minus 2 lakhs, that is 2 lakhs is the expense. As a net approach also, we will see that the depreciation 2 lakhs, and in gross approach in net also the 2 lakhs is the expense. So related contingent liability and asset is to be treated in accordance with Ind AS 37. If we will make the deferred grant liability, or we will make the grant, we will make also the contingent asset or liability. In future, if we will not going to fulfill the condition, for that we will make the contingent liability, make a disclosure in the contingent liability as per Ind AS 37 for that grant which the company is to be received. If the condition is to be fulfilled, that liability is no more created, but till that up to 20 years the company has to create a liability. After 20 years, if the company will fulfill the condition, the grant will be okay. If the condition is to be not fulfilled, for that purpose the liability is to be created as per Ind AS 37 contingent liability. Only disclosure is to be required for that. Suppose a government gives a grant of rupees 40 lakhs for research and development of one formula which is used to prepare a COVID vaccine to XYZ Limited, a pharmaceutical industries, even though similar vaccines are available in the market but are expensive. Means, for in this example, government has given a 40 lakh rupees for research and development to a company for making a formula of for COVID vaccine to XYZ Limited. XYZ Limited is pharmaceutical industries. Even though the vaccine is present in the market, but it's too expensive. So in order to reduce the cost of that vaccine, the government has given that company to make a formula of the vaccine, and government has given a grant of rupees 40 lakhs. The entity has to ensure by developing a manufacturing process over a period of 4 years that the cost come down by at least 40%. The condition is to be that the cost of that vaccine is to be comes down by at least 40%. If the condition is to be fulfilled, the grant is to be okay over a period of 4 years. Examine how the government grant be recognized, assuming pharmaceutical limited having a reasonable assurance that the condition attached to the grant will be complied with. There is a reasonable assurance that the condition attached to the grant will be complied by the company. Then what happened? And if there is no reasonable assurance that the grant will be, conditions attached to the grant will be complied with. So if there is a reasonable assurance that company will fulfill the condition, then how the company will treat that grant in its book. The entire grant should be recognized immediately. As and when the company will grant the grant, it will recognize immediately as deferred income and charge to profit and loss over a period of 4 years. So what was the accounting treatment? The bank account debit, whatever the 40 lakhs the company received, it will be debited by, and the credit will be the government grant. And at the end of the first year, what was the entry? At the time of receiving, they will make the make bank account debit to government grant, to deferred government grant. Then at the end of year, when the first year over, then deferred grant will be debited by 10 lakhs, and profit and loss is to be credited by, as another income is to be credited by 10 lakhs. In the same way, the second, third year will be shown, and the suppose the company government has given the grant of 10 lakhs, okay, and the company has expense on that research and development 16 lakhs. So 10 lakhs is to be treated as an income, and 16 lakhs is to be treated as an expense. In case of in case of gross approach, because it is to be shown separately, and in case of net approach, the 16 lakhs, that is the expense, minus 10 lakhs, which is the income, 6 lakhs is to be treated as an expense in the P&L. And if the expense is, suppose in case the expense is less than the grant received, then 1 lakh is to be treated as another income. So this is only the income or expense approach. This is not an asset approach. It's a income expense approach. Another approach shown separately. Yeah, at 10 told that there is a gross approach and net approach. So we will treat accordingly. Gross approach, in which the grant and income and expense is to be shown separately, because it is an expense approach, so we will show the income and expense separately. And in net approach, we will reduce the expense or income accordingly. Now, concept of non-monetary grants. What are the concept? What is the concept of non-monetary grant? Means that kind of grant which is given by the government to the company free of cost, without any consideration. Suppose the government has given a land to set up a business in remote area, free of cost, without any money consideration, that kind of grant given by the government to the company is a non-monetary grant, or is a non-monetary grant. Suppose the government has given a machinery to the company without any cost. So how the company will approach? How will the company will treat that? How the accounting treatment is to be done in the books by the company? First approach is the fair value approach in case of non-monetary grants, and second approach is the nominal value approach. Fair value approach is that approach. Suppose the government has given any kind of land or any kind of machinery to the company. So without any cost, without any consideration, monetary value, so only land is to be given. So the government, the company will recognize, find out the fair value of that land. What was the fair value of that land, and recognize in its books at a fair value. Recognize the asset and grant at fair value in case of non-monetary assets. Second approach is nominal value approach. Nominal value means government has given free of cost any kind of asset or any kind of expense government has incurred free of cost without monetary assistance. So how the company will recognize? Company will recognize that asset or grant at a nominal value. Nominal value means rupees 1 is the nominal value. Company will recognize that asset as a rupee 1, or grant as at a rupee 1. So it's a nominal value approach, and fair value of approach is at a market price. So suppose it is to be explained via example. Suppose government has given a machinery to the company free of cost. Life of the machinery is 6 years. First approach is the fair value approach. Company will recognize the machinery and grant at fair value. Company will find the fair value of the machinery and recognize in its books. The accounting entry will be, suppose the fair value of the machinery is 60 lakhs and government has given free of cost to the company, and company will find the market value of that machinery and recognize in its books at a fair value. The cost of machinery is 60 lakhs, that is machinery account debit with the to deferred government grant 60 lakhs. Whatever the cost of machinery is the grant given by the government. Then charge depreciation accordingly over the useful life of the asset. The useful life of the asset is 6 years. So 60 divided by 6, that is depreciation to accumulated depreciation. Charge to P&L and deferred grant. Whatever the grant is there is to be charged over a period of 6 account debit to other income. In case of non-monetary government grant, the ultimate impact on PL will be 0. That is 10 minus 10 equals to 0. Second approach is the nominal value approach. That is, suppose the government has given a machinery to the company at free of cost, and for taking company will not pay anything. Means government has given a machinery free of cost and not taking anything, without paying anything the company government has given. Life of the machinery is 6 years. Company will recognize the machinery and government grant at a nominal. Nominal value means rupees 1 is the nominal, machinery account debit to deferred grant and deferred grant account debit to other income. There is no depreciation because the value is 1 rupees 1. So how the presentation is to be done? In gross approach, the presentation is to be done like grant related to an asset. If the asset is given by the government to the company, then it is to be presented in the balance sheet as a asset in the asset side, and in liability side deferred grant in gross approach. In a net approach, the carrying value of the asset from grant, carrying it is to be reduced from the carrying value of the asset. Both asset and grant is to be netted off, and both in gross approach both asset and grant is to be seen separately. In case of asset, in case of related to income, if any grant is received as an expense incurred, for that it is to be presented separately. That is, if the grant is to be received for the reimbursement of the expense, it is to be treated as other income in under P&L, and income and expense is to be shown separately. And in case net approach, the deduct in the reporting the related expenses from the income. Whatever the grant is to be received and the whatever expenses to be done is to be netted off, and both the income is to be netted off in the net approach. So the disclosure part is to be treated by example. This is the disclosure part. This is the case study which is going to be done. That is case study related to government grant related to asset. Asset means capital approach is there. In case of gross approach, like XYZ Limited received rupees 60 lakhs as a government grant to set up a remote area. Means any factory, it's receive a rupees 60 lakhs grant in order to set up a factory in a remote area. The cost of the factory is to be 400 crores and the government has given 60 lakhs for that. So in balance sheet, the property, plant and equipment, that is factory, is 400 crores for that. From that, in case of gross approach, so asset and the liabilities to be shown separately. So asset, the value of the asset is, that is the value of the factory is 400 crores. That is to be shown separately in the asset side as PPE, and we will depreciate the asset over a period of 20 years. That is 20 crores is the depreciation and net asset will be 380 crores. And in the balance sheet, in the liability side, non-current liability, deferred government grant, that is the government has given 60 lakhs for that asset. So 60 divided by 20 over a period of 20 years minus 3 lakhs, which is to be current liability. 3 lakhs is the current liability because 60 divided by 20 is 3 lakhs per year is the income, deferred income, that is to be a current year liability recognized within 1 year, that is deferred non-current and current liability. So 1 year liability is 3 lakhs and other than 1 year, that is it's almost for 20 years, no? So 3 for the current which is recognized within 1 year is the current liability and other than that is non-current liability. So 57 is the non-current liability. In profit and loss, expense depreciation is to be of 20 crores and income, it will be income, other income, government grant, that is 3 lakhs. In this way, the disclosure is to be done for the gross approach, and in net approach asset side, the 400 crores, the cost of the factory, for that we will reduce the grant 60 lakh, remaining amount is the net asset, and for that depreciation is to be charged over a period of 20 years, that is 19.970, and net asset after depreciation is 379.43, and that depreciation is to be charged to P&L as an expense over a period of 20 years, that is 19.970. Now case studies related to government grant related to income, that is related to asset, and now related to income in case of gross approach and net approach. Like government has given any kind of expense which is the company already incurred or which the company is going to incur in future, for that kind of grant is an expense approach. There is two approach, that is gross and net. In gross approach, it is to be expense and income is to be shown separately, and in net approach is to be expense and expense is reduced from income, and the balancing, if there is income or expense, is to be shown in the P&L. So the example is, suppose XYZ Limited has received a government grant of rupees 40 lakhs to deferred expense for environmental protection. Expected environmental cost to be incurred is rupees 10 lakhs for the next 5 years. How should the company present this grant in its books? In case of gross approach, the grant will be which is received from the government. The grant which is received from the government amounting to 40 lakhs. It deferred over a period of 5 years and recognized as 8 lakhs as other income P&L account. So the government received 40 lakhs as deferred income over a period of 5 years. So it will recognize 40 by divide by 5 where 8 lakhs as an income over a period in the P&L, and the expense which the company has incurred is suppose 10 lakhs each year. So 10 lakhs is to be shown separately as an expense in the P&L, and that 8 lakhs is to be shown separately in the P&L as 8 lakhs too. That is the gross approach. In net approach, the 8 lakhs is the income and 10 lakhs is the expense, is to be netted off, and rest is to be expensed off in the P&L if the expense is there. In this case, there is an expense is more than income, so is to be charged to P&L as an expense. Next is repayment of government grant. In case of repayment of government grant, what happens if the company does not fulfill the condition, or the company has submitted false documents to government, or the company has made any error or fraud for granting a grant, for taking a grant from the government, in that case the grant is to be repaid by the company to the government. So in case where the company not able to fulfill the condition due to error or fraud or due to unavoidable circumstances. Error includes fraud, and fraud is due to intentional or unintentional fraud as per Ind AS 8. Fraud is due to intentional fraud is there or unintentional fraud is there. So unavoidable circumstances means the circumstances which are not under the control of the company. Any earthquake, any such situation, natural disaster, which are not under the control of the company. For that, the company is not able to fulfill the condition. And if the company will not fulfill the condition, then they has to repay the government grant. In that case, they will apply the prospective approach, not retrospective approach. But the company has submitted a wrong documents. The company has willfully defaulted to fulfill the condition. The company does not make any effort to fulfill the condition, and company has taken a grant by giving false documents to the government. In that case, they have to restate the financial, pay the government grant to the government. In both the cases, they have to repay, but in unavoidable circumstances, which is not done by the company intentionally, then in that case the company has to restate its financial statement prospectively. But in case of fraud or intentional error, then they have to restate its financial statement retrospectively. Government grant is an estimate, it's not a policy. It will be treated as an accounting estimate, because the company has to estimate that there is a probable assurance, there is reasonably assure, the company will reasonably assure that they will fulfill the condition in future. So it's a kind of estimate. In case where the company receive a grant and there is an error or intentional fraud in estimation, that the company will fulfill the condition, but the company has made no effort to fulfill the condition and made a false documents, in that case account has to be retrospectively restated. As said earlier, in case of willful default, if the company has made an intentionally default, not able to take any effort to fulfill the condition, in that case the company has to restate its financial statement retrospectively. And in case of unintentional error, like due to COVID, the company will not able to fulfill the condition because of unavoidable. In that case, in that circumstances, the company will repay the grant and account is to be restated prospectively. Prospectively means they has to restate for the period which are upcoming periods, and retrospectively means they have to restate their financial from back. So grant related to income, like any grant related to income, first against first against unamortized deferred credit, balance to be recognized immediately in the P&L. Firstly, whatever they explained by example, the just government has given a grant related to expense of rupees 50 lakhs for 5 years. In first year, it will be treated as an income amounting over a period of 5 years. So it is amortized over a period of 5 years, that is 50 divided by 10, that is 50 divided by 5, that is 10 lakhs each year. So balance in deferred grant is 40 lakhs, and again the second year it will be 10 lakhs, and the balance in deferred grant will be 30 lakhs. Company will defaulted in the third year and entire grant is to be repaid to the government. So what was the accounting treatment? At the time of default, the company make that credit of grant, remaining balance is to be debited. That is, in the remaining balance in the second year is 30 lakhs, because 20 lakhs is to be treated for 2 years as a other income. So remaining balance will be 30 lakhs is to be debited and credited. The company has to repay full 50 lakhs to the government. So government grant payable at the time of default, not at the time of making payment. So 50 lakhs is to be credited by government grant payable. They will make a liability of that. The company will make liability, and whatever the balance is to be reversed, and the remaining amount is to be treated as an other expense. So deferred grant account debit 30 lakhs, other expense account debit 20 lakhs, to government grant payable account debit to 50 lakhs. And when the company has to repay the government, at the time of making payment, the government payable account is to be debited and bank account is to be credited. Now, grant related to asset, that is previously related, that grant is related to income, and now grant related to asset in case of repayment. In case the company will default, they has to repay the grant to the government. In case of repayment of grant related to asset, it shall be recognized by increasing the carrying amount of the asset. They will increase the carrying amount of the asset or reducing the deferred income balance by the amount repayable, as the case may be. The cumulative additional depreciation that would have been recognized in the P&L to the date in absence of grant shall be recognized immediately in the P&L. Gross approach, there is two approach, that is gross and net approach. If the company follow gross approach at the initial recognition, then how they will make the repayment, what was the entry at the time of repayment, we will see. Cost of asset is 10 lakhs, life of the asset is 5 years, and grant received is 6 lakhs. The entity has to repay the grant in case the company default the condition, and in our example, the company will default in year 3 and has to repay the entire grant to the government. So in gross approach, in balance sheet, the company will show at the time of initial recognition, when they get the grant from the government. At that time, they don't know that they will not fulfill the condition. So they will recognize 10 lakhs as an asset, and in liability side, they will recognize 6 lakhs as a grant. And in PL, depreciation is to be recognized for 2 lakhs, that is 10 lakhs divided by 5 years, that is 2 lakhs as an expense, and that grant is to be amortized over a period of 5 years, that is 1.2 lakhs, treated as an income. In case of gross approach, it should be shown separately, that's why it's not netted off. And in the same way, the interest to be recognized in second year, and balance at the end of the second year will be asset, that is asset 10 lakhs divided by minus 2 lakhs depreciation in first and 2 lakhs in second year. So balance in end of the second year will be 6 lakhs, and deferred grant will be 6 lakhs, and the amortized over a period of 2 years. So 2 years is already amortized. The remaining balance will be 3.6. 6 minus 1.2 minus 1.2, that is 3.6. So this is the balance at the end of the 2 years, and third year the company will not fulfill the condition, so they has to repay. So at the time of default, they will make the entry, whatever the grant balance is there, they have to reverse that, the deferred grant account debit, that is 3.6. They has to make a liability for government grant payable, that is 6 lakhs, and other remaining balance is to be other expense. And at the time of payment, they will make the government grant payable account debit 6 lakhs to bank account. This is the gross approach. Net approach is quite critical, but we have to understand that in net approach, the cost of the asset is 10 lakhs and life of the asset is 5 years, and grant received is 6 lakhs. So in third year, they will default, and in balance sheet, in net approach, we will at the time of initial recognition, when we will get the grant, 10 lakhs minus 6 lakhs, 4 lakhs is to be shown as a cost of asset, and depreciation is to be charged on 4 lakhs over a period of 5 years, that is 80,000. And the first year is okay, second year the same interest to be passed, and the 80,000 is to be treated as a depreciation and charged to P&L as an expense in net approach, and in balance sheet asset is to be shown. No deferred liability is to be shown, because in net approach carrying value is to be reduced, grant is to be reduced from the carrying value, and depreciation is to be charged. So there is no deferred liability in net approach. In net approach, grant will be nil and deferred grant liability will also be a nil. In the same way, the entry is to be recognized in the second year, but at the end of the year, the value of the asset will be what was the value of the asset, because 4 lakhs is the cost of the, because after reducing grant from the cost of the asset, the remaining value is 4 lakhs, and 2 years depreciation is to be charged. That is what 1,60,000 is already charged. Remaining balance will be 2,40,000, and deferred grant will be nil, because the asset is to be, the grant is to be received from the cost of asset, so there is no deferred grant liability. And at the end of the year company default, then firstly we will calculate the depreciation as if grant is not received. So we will take the cost of the asset as full value, that is 10 lakhs, and depreciation is to be charged over a period of 2 years. Then we will take the cost of asset 10 lakhs and depreciation charge on that, that is 10 divided by 5, that is 2 lakhs. And then at the end of second year, the value will be, the cost of the asset will be 6 lakhs after charging depreciation. So but 6 lakhs will be the total depreciation required to be charged for the period 3 years. 3 years depreciation is required to be charged on the cost of the asset as if no grant is to be received, that is 6 lakh. Actually we had charged 1.6. Actually depreciation is already charged on when the grant is to be received, that is 1.6. Now additional depreciation that is to be required to be charged, that is 6 lakhs minus 1.6, that is 4.40, is to be recognized in the year 3, third year. And the cost of the asset in the year 3 will be, that is 10 lakhs. Carrying amount of the asset at the end of the year 3 is 2.4. And we will add the repayment of grant in case of default, that is the grant repaid. Then we will add back the repayment of grant, whatever the government company is taking the grant, that is to be added back to the carrying amount of the asset. So total value of the asset is 8.40 at the year 3, and the year 3 depreciation is 4.40. So net carrying value of the asset at the end of the year 3 is 4 lakhs. So 4 lakhs is the value of the asset, cost of the asset or the carrying amount of the asset in the third year. The entry will be at the time of non-compliances, that is year 3. In the year 3, what will be the entry? Asset, whatever the asset is to be increased with the grant, so that asset is to be increased, debited by 6 lakhs, and grant payable is to be credited by 6 lakhs, and depreciation account debit 4.40 to asset account, and at the time of payment, grant payable, that is 6 lakhs to bank. That will be the entry. Then this topic is also very important, loan from the government. If the government has given any loan to the company, whether interest-free loan or concessional loan or forgivable loan, any kind of loan government has given to the company, that loan is also treated as a grant, government grant. From a government for which the company has, for which the government has taken or undertaken to waive repayment under certain prescribed condition. if the company will fulfill this condition, I will forgive or waive off your loan. So if the company will fulfill the condition, the government will forgive the loan of the company. When there is a reasonable assurance that the entity will meet the terms of forgiveness of the loan, then only they will get the forgivable loan. Loan at a below or market rate means loan given by the government at a below market rate of interest is treated as government grant. These loans shall be recognized or measured as per Ind AS 109, that is as per financial instrument as per fair value. We will find out the present value of that loan or that the interest part. Government loan at a below market rate of interest shall be measured, means if the loan is given at free of cost, then only they will treat that loan as per Ind AS 109. And if the below market rate means the market rate of interest is 10% and government has given at 4%, then that also will be treated as a in accordance with the Ind AS 109 and also treated as a government grant and proceed as per. And the difference between the initial carrying value of loan determined in accordance with Ind AS 1 the proceed received. Whatever the difference is there, that is will be treated as an interest part. This is to be explained by example. That is, Government of West Bengal has given interest-free loan to XYZ Limited of for rupees 20 lakhs. Period of loan 5 years. Market rate of interest is 10%. 10% is the market rate of interest and loan period is 5 years and amount of loan is 20 lakhs. That is interest free. Government has given interest free loan of amounting rupees 20 lakhs. In this case, Ind AS 109, that is financial liabilities to be applied. Interest free grant up to Ind AS 20. Government grant is proceed from government, that is proceeds from the loan. Whatever the loan proceeds are there, minus the present value of the outflow of the loan. So first we will find out the present value of the outflow of the loan. Loan amount is 20 lakhs and is to be period of loan for which the loan is to be given is 5 years and the rate of interest is 1.10%, that is 20 lakhs is the value after 5 years. What is the present value of that loan? That amount includes the interest part also. Interest free loan is if the 20 lakh is given by the government today, which is interest free, so for a period of 5 years. So what was the actual amount of interest? What was the actual amount of loan is to be present value of the loan we have to find out by using the market rate interest rate. Why? By using the market rate of interest for a period to be divided by 20 lakhs is to be divided by the rate of interest to the power of 5 years. So today the present value of that loan is 12 lakhs 41,000 and the interest part on that loan is 7 lakhs 58,000. So 20 lakhs is given by the government today, interest free loan on which the interest part is 7,58,157 and loan part is 12 lakhs 41,843. So that interest part is also treated as a government grant because government has given interest free loan. So the amount which includes loan interest also, that is treated as a deferred grant. So interest part is treated as a deferred grant. 5. The opening balance of the amount is 12 lakhs 41,000, that is the actual amount on which 10% is to be charged, that is 12 lakh is 10% over here 1 lakh 24,000. Then on that we will add, though that is the closing balance 13 lakh 66,000. Then that is again the next year opening balance on which interest to be charged and the closing balance will be 15 lakhs and that 15 lakhs on which the interest to be charged at a rate of 10% and that will be 16 lakhs. And in this way at the end of the 5 years the 20 lakhs will be there. And the grant will be, the interest part is the grant receivable, that is the government interest free loan. So the interest part is the grant which the company has received. So opening balance will be 7,58,000. That 7,58,000 is amortized over a period of 5 years as an other income. So 758 is divided by 5, that is 1,51,631 is amortized over a period of 5 years. So opening balance of that interest and other income. So opening from that deferred grant, we will reduce the other income because it is to be amortized over a period of 5 years and charged and recognized in PL as an income. So the closing balance get reduced day by day, and the end of the year 5 it will be 0. Net impact on P&L. Interest is the expense part. Income is the amortized over a period of 5 years, and the net of that impact is in year 1,24,000 is the interest that is to be paid, which is free of cost, and other income is 1,51,000. So 2,27,000 is the other income. In next year, in the same way, 3 years there is income, and last 2 years the expense is to be recognized in the P&L. Now, what is government assistance? Government assistance means any kind of support which the government is giving to the company free of cost without any monetary value. That is the government assistance. Assistance which cannot reasonably have a value placed on it. Transaction which cannot be distinguished from normal trading transaction. Example, government procurement policy resulting in a portion of entity sale. Any policy which the government has taken for entity sale, so that kind of transaction. Action by government designed to provide an economic benefit specifically to the entity or range of entities qualifying under certain conditions or criteria. For example, technical support or marketing advice or government procurement, any kind of advice free of cost given by the government in order to for the improvement of the company. That kind of benefit is to be given. Disclosures if necessary so that the financial statements are not misleading. So only disclosure requirement is there for the government assistance. There is no monetary or accounting treatment for that. Now disclosure in case of government grant and as government assistance, whatever we will learn, how the accounting treatment is to be done and how the disclosure is to be done in both the in case of government grant and assistance in the financial statement, like accounting policies, what policy we have adopted, the company has adopted for measurements and presentation, nature and extent of government grant, how much, what kind of government grant is there, what percentage of government grant is to be recognized in the financial, what kind, nature and extent, indication of other form of government assistance. If government assistance is there, is to be disclosed. Unfulfilled condition and other contingencies. If the company is not going to fulfill the condition, then repayment of government grant, it also is to be disclosed. And if the company is just reasonable certain that they will fulfill the condition, then you will make a contingent asset or liability and disclose in the notes to the amount recognized. Now there is a difference. What are the difference between the Ind AS 20 and AS 12? AS 12 is Accounting Standard 12, that is the old version, and Ind AS 20. What is the difference? Government assistance. Government assistance is the new topic, which is Ind AS 20 only deals with government assistance. There is no guidance available in AS 12 related to government assistance. So in Ind AS 12 or 20 only the government assistance part came, the guidance available in Ind AS 20 only. There is no guidance in AS 12 related to government assistance. Non-monetary assets. In AS 12, non-monetary asset given at a concessional rate should be accounted for at the acquisition cost. In AS 12, it will be accounted as an acquisition cost or a nominal value. There is two cost is there, and if given free should be recorded at a nominal value. या तो acquisition cost में AS 12 बोलता है acquisition cost या nominal value. Ind AS 20 बोलता है fair value, government grant को recognize at fair value or at a nominal value. Any of the either you will follow the fair value in case of non-monetary asset or you will follow the nominal value. बस AS 12 बोलता है या तो acquisition cost you will follow the acquisition cost method or you will follow the nominal value. Forgivable loan. There is no guidance available in AS 12 related to forgivable loan, but in AS 20 there is a guidance available for forgivable loan. Means any loan which the government has given to the company, if the company will fulfill the condition related to that loan, then that loan is to be waived off by the government to the company. Loan at a below market rate, that is interest free loan or concessional rate loan, that guidance is available in Ind AS 20, but there is no guidance available in AS 12. Grant, government grants, promoters contribution. This promoters contribution government grant, there is no guidance in Ind AS 20, but that grant is like promoters contribution should be credited to capital reserve in AS 12. That guidance is available in AS 12, and if any grant related to promoters contribution, if the government has given any grant related to promoter like promoters contribution, should be credited to capital reserve and should be the part of shareholders fund. Thanking you for watching my video. If you like, please subscribe my channel. Please share my channel so you will get the notification